Good afternoon, everybody. This is Paul. All right, welcome to this evening. If you are newer, welcome to DTS. We have new people, it seems, joining all the time. I've been around a while. I started DTS 2.5 years ago after being in the business and trading for the last 2 decades. My biggest regret was I didn't do this a long time ago so that I could just properly have fun and educate people on what I do without having to worry about the burdens of big companies and what they have. You can always pick up the schedule at DTS by going to the calendar page, which is right here. And on there, the things that are in a nice royal blue are things that are for DTS subscribers only. There's seminars and stuff like that, but the rest of the things on there in kind of a lilac color, for lack of a better term, are things that are free to members. As a member, if you're here, you're only here because you're a member and you get invites to all these educational events. You get some occasional educational emails and some good things like that. So these events are meant to be educational. These are not like sales types of things. Don't care. Just simply an effort to try and help the people who want to get help to the extent that I can in a free environment. One of the things that has developed at DTS, if you are newer, is something called the free stuff page, which I get more and more people emailing me saying, wow, I just literally had a guy yesterday, that's what made me think of it, say, I ran across you and I spent my entire weekend listening and I think I got to 80% of your videos. These are just free videos and they're not little garbagey things. They're actually what I would call high-end in terms of learning material. A lot of it may escape you. It depends if you understand me or like my style. But it's a lot of good peripheral material. So with that, we're going to hey Fire Tower, we're going to begin tonight. So because I have a lot of things to go over. Let me explain tonight. Whenever I do these events, I just keep this document of my ideas I want to express and talk about, and it just keeps growing faster than I can do the webinar, so I'm never at loss for ideas. And I had something else originally scheduled for tonight. Last time, which was 3 weeks ago tonight, I did day trading A to Z, which originally was meant to be the total. But something funny happened afterwards. I got more emails and positive response to that than probably any other educational event that I've done. And also came with a lot of questions, good questions, not like I don't think they were like, oh, you missed this. They were just more expansive things. So I made the decision to do a part 2, even though the last one's not called part 1, which will confuse somebody someday when they go and they see these, because the last one's called A to Z, and then there's part 2 that actually doesn't make any sense at all. But I can't go back in time, so that's what it is. I don't know what comes after A to Z. Anybody help me out with that? I don't know. So once you goof up, you can't go back. So this is just called part 2. And I specifically have some questions to go over and also go into more detail on some stuff. And what it actually turned into, even though this one was specifically about day trading, naturally, everything that I teach in terms of trading, I call trading, but I like long-term trading, which you might call investing if you want to, and I like day trading. I don't really like anything in between. But it's all the same technique. So when you have questions about day trading, a lot of them just become general trading questions. There's no real difference. But this drew a lot of attention, and I don't know, maybe it's because there's more people at home that are, looking to do something, or I don't know, but I got an awful lot of response to the last one. So that's where we're going to go tonight, and that's my 5 minutes. I do want to get going because I once again have way more than I'm going to be able to probably go over properly. So double A to double Z. And you don't think that would confuse people. You don't think I'd get a slew of emails saying, Paul, you made yet another typo. You put too many A's and too many Z's in this thing. I would just see, well, I can't use you as any kind of administrative assistant because you just don't get it. All right. A to Z 2.0. Now that's almost okay, Chuck. That's almost there. Anyway, so let's go on. So tonight, here we go. Here's the original slide with some additional topics. Time frames, going into what it means to day trade different time frames. Statistics on trades. I'll explain to that when I got there. This deviated a little bit from what I originally intended because I'm lazy. Okay, I'm lazy, I said it. Styles and management will be a good section, and evaluating trades and management. Naturally, to go into each of those topics in total would require about 8 hours. So we're going to kind of quick hit some things in there to give you a really good idea. Here specifically are, I think, 3 questions, and or there's some other questions, but they're either going to be answered tonight. These I just want to pull out and show you. We'll specifically get to these. They're built into the presentation. But I showed some stats from March in the last one because it was April 5th or whatever. The 5th, the 3 weeks ago, is April 8th. So I did some March summary from the trading room, and it wasn't loaded with statistics. I'll explain why. It was just kind of a summary. So somebody wanted to know what the batting average was. So that brought up another question because I had other questions about batting average, which I have an opinion about. So I want to go into some detail on that. So we'll do that question in a minute. How much capital is needed? That's a simple one. That's just an answer. I'll let you know. I didn't get into that because people are saying, well, if I'm going to make that much money, how much capital do I need to bring to the table? So the third one is, I've been struggling. Do you have any advice? I don't mean training wise. I just mean ways to see what I'm doing wrong. So we'll touch on that too tonight. So here we go. Time frames in day trading. This won't take long, but it was a common question. People are asking, you make this money, what are you looking at? I understand you're looking at charts, but what charts, when, what time, all this good stuff. So here's the quick rundown. By definition, by the way, I not only have been kind of busy, but for some reason I got a little extra behind this week. So don't laugh at me if there's, actually I've been really good on these presentations because they go on YouTube. So, but if there's a typo somewhere, just be easy on me because they were barely reviewed. By definition, day traders are intraday. Naturally, anytime you hold more than intraday, you are whatever you want to call yourself. We use the term swing trader sometimes, core trader, long-term trader, long-term investor. They're all just English terms. They don't have any real trading significance. But as a day trader, there's some significance because it means you're flat every day. It also means if you're going to be a day trader, you have to be actually classified as a day trader, a pattern day trader. We'll talk about that just real quickly later. It could be that you, as a day trader, you hold all day. You could take a position almost first thing in the morning. In other words, you could kind of be swing trading, but not holding overnight. In other words, you kind of grab something in the morning, hold it all day. Of course, that would kind of defeat the purpose because in the last 3 years, 4 years, and somebody, I don't have the exact stat on this, but about 80 to 90% of the profit in the last 3 years in the market came overnight. So those of you that say, I don't want the risk of holding overnight, well, you're also passing up the opportunity of making money. So that's why I do believe very much that two styles are always warranted, where you are holding overnight in a longer term account to catch these big moves when they happen, and then also day trading for income, because sometimes the market doesn't go anywhere, and yet as a day trader, we don't really care about if the market's going up or down at all. That's another little fallacy I run across a lot, is that people saying, well, gee, the market's been heading down, it's been going sideways, that's not good for day trading. And that's not true at all. As a matter of fact, a choppy sideways market is really exactly what I want for day trading. It's what a lot of people want. I don't like an uptrending market to day trade. It's actually more difficult to me. So you can also be holding for seconds. A very fast style of day trading, be holding for seconds. What we're doing is we're using charts, and we're just using different time frames of charts. You could use a 60-minute chart where every bar represents 60 minutes. There's 7 a day, and you're taking, this is just the cues over the last recent time, and I snagged them today. And you can be looking to take the setups like right here that you find on any time frame and hold them, for the day, or hold them overnight a night. That wouldn't be day trading, of course, but you could do that. We could also come down and use a 30-minute chart that shows. We could use a 30-minute chart, or we could use a 15-minute chart. We can use any time frame we want to. And if you're trading strategically from the bars on the chart, what you're doing is just kind of picking up the pace all the time. Instead of waiting an hour to get an entry, you're waiting 15 minutes. Instead of holding 4 hours, you're maybe holding 1 hour. So you're just kind of increasing the speed at which that you are trading, if that's the case. Could we use, here's a 21-minute chart, I think that is. Could we use a 21-minute chart, anybody? I just showed you a 15, a 60. If you've been poking around or you're new at trading, you probably heard of these time frames, 5 minute, 1 minute. Could we use a 21-minute chart? That's a weird time, 21 minutes. Could we use that? Yeah, you can use, I don't care what you want to use, really. What matters is just that you get used to the time frames. I don't suggest you switch around a lot. Like every chart has its own face, its own personality. Same thing if you're going to use moving averages. You can use any ones you want as far as I'm concerned. People have these arguments, if you go on, people will show me these snippets from chat lines, where people who generally don't know what they're doing are giving advice to other people who generally don't know what they're doing. And they're arguing about what moving average to use and whether it should be exponential or not. And the answer is, who cares? It doesn't matter. What you're learning is a picture, a certain look, a concept. It's like looking at the face of a person. There's no right or wrong. It's just a matter of getting used to it and being able to, so there's no change, is all that I say. Now, there's one little tiny advantage to using a 1 minute chart, 5 minute, 15, 60, maybe a 30, and that is something called self-fulfilling prophecy. Most people use those, so you see what they're seeing. And sometimes when you get better than average, you can see, things that people are looking at that are fictitious. There's this whole world of traders out there that are just wrong. They just have these misaligned concepts, and they use technical indicators, and they use fancy lines, and they think the world responds to these things, but they don't really. And a lot of times they appear to work because if you are playing in the right direction at the right time anyhow, by coincidence or because your thing worked that time, it looks like your thing works. But when you use your thing and it is against the price pattern, then you make a mistake that at least I can identify, and it helps sometimes. So I don't mind the self-fulfilling prophecy, but it's really not critical. If you feel 13 is your lucky number, go for the 13-minute chart. That's just fine with me. Now, one question comes up kind of is, well, how do you make money? I mean, how do you make money? If you're taking, if you're taking 100 shares of something and you're on a 60-minute chart, I can see it move all day. I can see, okay, wow, they made a couple $100, great, but you're on a 1 minute chart and you take a couple hundred shares and it moves 13 cents? How do you make money doing that? How do you make money on a 1 minute chart? How do you make money on a 1 minute chart? There's a 1 minute chart. So this entire breath you're looking at is a couple of hours. Yeah, right, Fire Tower. I mean, as you're moving down, you're proportionally moving up your share size. In other words, I'm not really going to go there today, but it's not like a secret. When you come to the Friday class that I do for free for everybody, the introduction class, which is going to be, what's it going to be, June 4th or something like this, sometime first week of June. We talk about share sizing, and when you size so that you're risking a fairly equal amount of money in every trade. It means when you have a 1 minute chart, instead of a dollar stop, maybe you're going to have a 15-cent stop. Or let's keep the math simple. Let's say a 20-cent stop, which means that you could have 5 times as many shares, which means that any move, penny for penny, will have 5 times the profit. So a 10-cent move might have good profit. Does that make sense, folks? I know for some of you, this is, I get it. But for some people, it's fairly new, and this is a fairly common question. How do you make money? Now, one of the little fallacies I do want to bring out here is that there's a video on that website that I showed you, the free stuff page. It says, beware of these 2 time frames. And one of the time frames I talk about is scalping. Not that scalping is bad. I happen to not be a scalper, however you define that. But scalping is really good. I mean, I've been very close to, just kind of moving over to the scalping thing. But what a lot of people do is they're just bad traders, and when they don't know how to take a target, they'll say, I'll just scalp it. You ever heard that term? I'll just scalp it out. And they have their 200 shares, and they're trying to get a 50-cent move. And after it moves 6 cents, they get all nervous, and they go, well, I'll just scalp it out because, you can't go broke taking a profit, and they're done. That's not scalping, folks. That's just bad trading. When you're scalping, you know you're scalping. How do you know you're scalping? What's a quick way to, if you just glance over somebody's shoulder on their trading platform, what's a quick way to know if they're scalping? How do you just tell instantly they're scalping? Well, yeah, they probably wouldn't. Well, you know what, Peter? I see people that are trading a daily chart and they have a 1 minute chart up. They're share size. Guys, when you're scalping, you're trading a stock like BAC or something. If you ever traded BAC, you could buy 10, 15,000 shares with just a click, and you wouldn't even get noticed. Nobody even know you're there. You can't do that with every stock. When you're scalping, you're taking big share size, right? You're taking big share size, and you make money on the little moves. As a matter of fact, if you're scalping, if you take 10,000 shares, you get a 10-cent move. That's no different than taking 1,000 shares and getting a dollar move, right? It's just the math. So this is what day trading is, and there is no secret formula. There is no, what makes you a day trader. Any one of these time frames works. It more comes down to your personality and style. Do you want to be taking trades, every few minutes and getting out in a few minutes, or do you want to kind of sit back and take one and let it play out for a while? It's up to you. There is no right or wrong. Also, there's a thing called a tick chart. If you're a scalper, this is a tick chart, and a tick chart it goes below a 1 minute chart, and you can have a tick chart made any way you want. You can have a tick chart to be, I think this is a 20 trade tick chart. So every 20 trades it forms a new candlestick. You can have a tick chart to be every 10 seconds, every so many trades, whatever you want. So the time frames are all there, all tools for you to use in entry and management and in strategic concepts when you are day trading. Okay. By the way, do we ever, as a day trader, would you have a use for a daily chart, or is that just like the tool of the archaic swing trader? Would you ever use a daily chart? Oh, there's a tick chart. I'm sorry. Yeah, and me, that's where because I'm recording, that's fairly small, and I don't see that. Would you ever use a tick chart, a daily chart? This prior one was the daily chart. There it is. Daily chart? Sure. You wouldn't be trading on the daily chart. In other words, you wouldn't be saying, I'm going to take some kind of setup on the daily chart as a day trader. But as a good trader, there's certain things we look to across different time frames, and it is quite possible, as a matter of fact, I would say mandatory, that if you are a bigger time day trader, like a higher time frame, like a 15-minute chart, 60-minute chart, the daily chart is part of your recipe, let's just say for now. I'm not going to go into that now, but it's part of your recipe. If you're a smaller time frame trader, 1 minute, 5-minute chart is your main chart, you probably don't care about the daily. You could leave that off. Yeah, but for kind of all-day type of trades, half-day trades, the daily chart is going to play a role in what we look at. Okay, so that was simple, wasn't it? Off to a good start. Only 520 we got through one section because it's a simple one. All right, so let's get into the next one here. Somebody had asked, I showed the summary of the room from last month, and somebody asked, well, what was the batting average for those trades? Which brings up a bunch of questions for me in various aspects. I have a lot of opinions on this topic, and they range from good to the sublime to the sublime. I made that up. First, I want to tell you something, that if this is the only question asked by someone, it usually is a sign of a rookie, and likely one who has had a tough time at some point. Why do I say that? I get a lot of people sometimes, they'll ask about the room, and their first question is, what's the batting average? That's their question. Send an email, and that's the whole question. What's the batting average? And even though people are asking, I think one time I actually wrote back what it says in the next slide, which is going to be, who cares? Why do I say there? Somebody give me an answer. Why do I say it's likely somebody who's had a tough time at some point? I'm not going to answer for 3-4 minutes, but why do I think that somebody whose only question about your trading or your trading room, if their only question is what's your batting average, what can I tell about that person? Almost guaranteed. Well, maybe or maybe not, newbie, maybe. No, maybe not his problem. Exactly. Dave has it exactly. Well, no, the answer is, yeah, you guys are hitting on it now. Let's hold off 1 second because it's going to be on the slide. I just want you to think about it for a minute. So here's the first answer for you, and don't jump on me because it's not going to be the total answer, but here's the first answer. If you're making money, who cares? If you're making money, who cares? Now, that's not totally true. You may care. Looking at your journals can be telling. But here's the thing. If you're doing what you want to do, you're making money and you're happy and there's no problems, if somebody comes up to you and says, oh, well, your batting average is too low, well, you have my permission to just kind of slap them in the face because, who are you? Who cares? What is the right batting average? We'll talk about that in just a minute. But it is a statistic that we use to either help us to improve or to maintain what we're doing. But all by itself, a batting average is completely meaningless. Because what's the other thing that matters? And I know most all of you probably know this next answer to some extent. But yet, based on the questions I continuously get, it's not well understood. What is the other thing that matters? Right, the fancy term for it is what we call the Sharpe ratio. And a Sharpe ratio, if you want to think about it, it's just the after the fact reward to risk, right? It's your average winner compared to your average loser. So if you're looking at a chart, I know a lot of people will say, oh, if I'm going to take that trade, it has to have a 3-to-1. What does 3-to-1 mean? Well, when people say it has to be a 3-to-1, I'm typing it on here, they typically mean the reward to risk. In other words, I'm going to go for a 60-cent target and my stop's going to be 20 cents. That's 3-to-1. Well, if you actually achieve that, on 4 consecutive trades, it doesn't matter if they're winners or, let's say 2 are winners or 2 are losers. So twice you get your 60 cents and twice you lose 20 cents. What would your Sharpe be? Sharpe B, not Sharpie. What would your Sharpe be at the end of that 4 trades? Anybody? If your reward to risk was set up as 3-to-1 and you held 100% either hitting your target or your stop, what would your Sharpe be? No. If your reward to risk is 3-to-1 and you either hit your target or your stop on every trade, so that your average winner actually was 3-to-1, your Sharpe ratio would be 3-to-1. That's what I was saying. It's just your after the fact batting average. If you held to your batting average, I mean, as your after your fact risk reward on a trade that you set up. So if you hold to that, that's what it becomes. So that's what it would be. But let's touch on that more in just a minute. Here's a question for you. I just like it because it's kind of an interesting question. If your average winner was 3 times your average loser, and that's what you did forever and ever, you always had a winner that was 3 times your average loser, how many trades do you have to get right to break even? How many trades out of how many trades? You have to get X out of X trades right to break even if every trade that you make is. So I'm saying your average winner is $1,500, your average loser is $500. How many trades do you have to get right? What batting average do you have to have in order to break even? That's a real question. Are we all calling out our kids to do the math for it? I have one answer. Is everybody going to agree with HT? No, there's nothing to tell you manage, Alvin. I'm saying after the trade's over, after it's over, every winner you had was $1,500. Every loser was $300. What percentage do you have to get right? Right. No, not 1 in 3. That's just tricky. It's 1 in 4. It's 25%. 25%. Just figure it out. Just, put it on a piece of paper. Winner, 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 loser. You need 1 in 4 right. And that's just kind of neat. 25% batting average would have you breaking even if your Sharpe ratio was 3-to-1. So if I told somebody that I had a 33% batting average, they may say, wow, never going to talk to that guy. He's an idiot, but yet could be making money hand over fist, right? So if you don't even ask the other question, you don't even know. But what I was starting to say was, why would someone who had a tough time ask first about batting average? It's because they don't like to be a what? It's very likely they had a very hard time in the past. They had a series of losses. They don't like to be a loser. They just don't like to be a loser. And here's the important thing I want you to think about if you are even close to having this problem. They don't want to be a loser on even a single trade. But having and handling losses is part of a winning trader, isn't it, everybody? If you listed the requirements of a fantastic trader, wouldn't one of the requirements be losses? Yes? I'm just trying to help you psychologically for those of you, because a lot of you suffer from this. I know. I know you do. But everyone, isn't that true? If you listed all the things about a great trader, one of the things in there would be he or she has losses. What they do is they're put in perspective with a whole plan of winning and losing that makes you come out a winner at the end of the day, the end of the week, the end of the month, right? Right. As a matter of fact, do you really think there's anybody who has no losses? There is nobody. There's nobody on planet Earth that has no losses. There's not. I've heard ridiculous stories about people that don't have losses. They have losses. I'm sorry. So what was the batting average? This is the summary of April that I showed. of March. I mean March, because this is the repeat from April 8th when I did this the first time, and that's what the stats were from the trading room. But I didn't do any other stats. Now here's why I didn't do any stats. I have gotten out of the habit of keeping a detailed stat log for myself. I don't recommend you do that until you reach some level. I think they're very important. About a year ago, for the purpose of doing a presentation, which was called a statistical trade review, I kept the stats for a month for what I do, and I went back and put them on the sheet that I use for 20 years. And I went through that and showed you that. And I think I'm going to do that again. To be honest with you, I kind of intended to do it after that last presentation, to go back and do it for March, and I just didn't. I'm sorry. But I think I'm going to. I've had this paradox that I just can't do all that work. I don't need to personally, but I think it's a good learning tool for the room and for you guys. So I'm going to take the sheet I use is too hard for anybody to understand. I just be getting questions all day. It's a sheet I created. I love it. It's great, but you know, if that's what I put out there, nobody would get it. So I think I'm going to take the tracking sheet I use and add some stats to it so they can always be there, because I like the stats. So the question was, what was the batting average for that? So it was a good month. What was the batting average? Want to take a guess? It's amazingly, paradoxically, I have a hard time getting very, very far off the 50% level. The actual batting average, believe it or not, was 49 and 50. And it's not always exactly where I am, but historically not far from that. And some people will say, oh, gee, 50%, that's not very good. Well, it made that much money. Now, what I don't have for you, I'm sorry, I don't have the Sharpe ratio because I didn't track this, and I just didn't want to go back and enter all this because I haven't normally been doing it. So I promise you, in the next couple months, we'll have another one of those sessions. It'll be called the Statistical Trade Review, and I'll go over it again. The last one's on the internet. I mean, on the web page if you want to do it, right? Yeah, I mean, technically, you could go figure the Sharpe ratio, Fire Tower. Yeah, because number of trades. That's over my pay grade, and I didn't feel like doing it. But obviously, the Sharpe ratio was good. So let me tell you the truth. I don't know my slides well enough tonight to think ahead, so I have to. Oh, here, 49 divided. Ready for this? 49, 49, 40. 0.49, 49, 49. You couldn't even hit 50%. What a loser. So batting average and Sharpe ratio are inversely related. And here's an important point, and here's where, even if you've been trading a while and you've only been getting your curiosity peaked so far by what I've been saying, here's something most people don't seem to get very well. They are absolutely positively inversely related. They are tied together with an umbilical cord. Does everybody understand that? They're absolutely tied together. Let me make my point this way. I'm going to bet, hey Carmen, I'm going to make a bet with anybody that'll take it. I can trade the rest of this month, taking 5 trades a day, and maintain a batting average of 90%. You just saw me for the prior month, I was 50%. Anybody want to take the other side of that trade? I'm going to bet you that I can maintain 90% batting average. If you bet me enough money, I'll do it into perpetuity for however long you want. Anybody? But anybody want to take the other side of that bet? I just showed you I have a hard time staying over. And by the way, when typically when I get up to like 60%, it's really a good month. Because usually I'm not doing it at the sacrifice of Sharpe. But I'll tell you what that means in just a minute. If you understand this bet, all these people here, and nobody's typing, would anybody take the other side of that bet? Yes, no? Those of you that typed on the screen, you're fired from typing anymore. You guys all type all the time. Where are the rest of these people? Right, because, and I know when I say this, you're going to just kind of chuckle, but I want you to understand it. You shouldn't take the other side of the bet because I would kill you every time. How would I do it? Right, I would set my target at 2 cents. I would set my stop at $5, right? And I would get every trade right. And if I lost one trade, it would be 1 in 20, right? I'd have to go $5 against. Now, would I make money doing that? Yeah, probably not. But I'm making money from you because you bet me. So what's my point? My point is that you can skew any number you want at the expense of the other. It won't improve your overall trading. And this is what so many people do, is that if you just come up with ridiculously easy targets, you increase your batting average, you decrease your sharp, you make no more money. And the average trader, just think about this. If you decide, okay, you know what? I've been taking these 20-cent targets on average as a day trader. Follow me here. I've been taking 20-cent targets as a day trader. And I'm not really making money. So I listen to Paul, and I'm going to increase my batting average. And the only way they do it is by taking the average 15-cent target. So now their batting average goes up, their average profit goes down, and they make the exact same amount of money. Does everybody agree with that? Understand that? That if you don't change anything in the bubble, if you don't change your knowledge base, your chart understanding, what you do, that when you increase one, you're just decreasing the other, right? Now, is this a decision that happens a lot in trading, or is it just kind of a rare thing? They have to make a decision between the relationship between your batting average and sharp ratio. I hate using these fancy terms, but is this something that, well, you know, every Sunday night during dinner I'll make a decision, or is this something that happens throughout every single day, throughout every minute of every trading day that you're alive? Guys, every single thing you do in trading, everything you do involves this relationship, whether you know it or not. If you take an entry with your stop here, right? You're going to have a lot of profit because you're going to have a big share size. Does everybody understand why? Compared to over on the right here. If you have this 20-cent stop, so that you can take 2,500 shares or whatever, but because the stop is so snug, you're going to stop out more often. So your batting average goes down, your average winner goes up. Come over here and you decide, well, I'd like to use a wider stop, or I'd like to use a bar that has a bottoming tail. Okay, well, now you have a 60-cent stop. But guess what? While you're taking a third of the shares, you're probably going to increase your batting average by 3 times. And at the end of the week, at the end of the month, at the end of the year, nothing changed. You had the same profit, but your sharp ratio and batting average are skewed. So obviously, what is the goal of this? Well, the goal is to be able to increase one while holding the other one steady. How do you do that? How can you, before I get that, hold off on that question. You guys got to start answering some questions here, because I'm getting bored up here. Before you answer that question, let me ask you another question. Which way do 90% of the traders lean when they have a decision to make between having a good batting average at the expense of their sharp ratio, or a good sharp ratio, average winner, at the expense of their batting average? Which way do 90% of the traders lean? In favor of BA or in favor of S? Yeah, 90%. And just so you understand why does virtually everybody want the batting average? Hint, hint, I kind of already told you. Yeah, feels good is the wrong language. Psychology is, just say what it really is. Well, I am right is the other side of the coin. That's not the psychological element, Peter. The psychological problem with people is not I want to be right. It's I don't want to be a loser. I don't want to be wrong. Yes. And you see it, and maybe this will tie it together for you, but you see it when you're trading and you're managing, right? You get in a position, it starts to go up, right? Okay, it turns green. I'm looking for $500 profit. I got $100 profit. I got $120 profit. And then all of a sudden, no, it starts to back up. And now I'm red. Now I'm down $50. Starts to go up again. What does everybody do? What does everybody do? As soon as you're down $50 and it starts to move up and now you're green again and you're up $50, what does everyone on planet Earth do? Everybody tell me. Bring the stop up to that new level to make sure that if it still has a problem, you're not going to be negative. The trade goes on to be a huge winner and you're break even. Congratulations. Trading, well, this is kind of what we talked about in seminar a little bit, but trading with a huge sharp ratio I think is actually a great way to trade. But it is something that requires a dedication to that style. You don't just all of a sudden decide one day, oh, I think I'll just go for big winners. You have to be dedicated to that style. What do? I try to do a blend, and this is a difficult thing to explain. Those of you who took class with me years ago, I always talked about taking that class and applying the tactics of any trade into the account. And it's what I try and do today, which is to say, I try and start off with a fairly high batting average, low sharp. Don't try for a low sharp. Build into the day, and then go for the big home run, I call it. A home run is a high sharp ratio trade. I had one this week. Had a big winner this week. So that's my style. That style, though, that's not part of what I teach per se. I teach you different options of different concepts of what to do. But your style can be any way you want it to be. You just have to have a style, and most people don't. Most people have, I'm scared and I'm chicken, and I broke even again. That's the average style out there. All right, quick question. We got to move on. Wow, it's late already. Holy cow. All right. So a quick question. How much capital is required to make that money? So what you saw on the last slide with the money made in the room that month. Did I put the answer on here? Yeah. The last 2 months has been tremendously less capital needed. For the very simple reason that things have been so wide and choppy and volatile that stops are wider and the targets are bigger. So I mean, if you're going for a 3-to-1 instead of having a 20-cent stop and a 60-cent target, you have a $1 stop and a $3 target. So you're just needing less shares. So for that month, the average was about 60K of buying power, which would mean $15,000 in a standard day trading account, 4-to-1 account. That's all you would need on average. Now, it's on average. It varies a lot from day to day. I'm not telling you there's never a day you need more than that. It's just an average, a ballpark average for that month where we're in the middle of coronavirus. So that's 15K in a standard account to make that much money. But remember, in a standard day trading account, you need 25K in there, period. Whether you use it all or not, you only need 15. Or you need about 6K in a 10-to-1 prop account. That would give you your 60K of buying power. Now, I have to tell you though, normally it's about twice that amount. And that's just I don't keep like a to the penny stat on that. I just keep that for people who ask. Normally it's been about twice that amount to make that much money. But naturally, if you didn't have that much money, you don't have to make that much money. You just, peel it back. You could risk $400 a trade or $300 or whatever you need to make the amount of money you want to make for the time that you're there. Okay? So that was just a quick answer to that. Let's, we're on the subject of stats here. So let me show you another one here. It's a big one to me. We're going over tonight, folks. Sorry. Here's a quote by me. And now, I don't think I mentioned this. As I went through this, I realized some of these topics were in some old presentations I did. So some of these slides I pulled. So if you're a real active person on the free stuff page, you're going to see some of these slides here because I didn't, why reproduce them? They're older from a while ago, and I'll put a different spin on them. But and actually, it took me so long to find some of these, I probably could have reproduced them quicker than trying to find them because I didn't know what presentations they were in. So anyone who wants to can learn to read a chart with plenty of precision to make money. If you make money with that knowledge, depends on your management. Eventually, all traders succeed or fail based on their management. That's a quote from yours truly, me and me only. And I can't say it better than it says there. You can learn to read a chart. It does not necessarily mean you're going to make money, and that's why people get discouraged because they only learn one small aspect of technical analysis, and that's just this very basic view of a chart rather than understanding how to make money from a chart. And there is a difference, and I think a lot of you know that already. So let me show you this for fun. This is one of my favorite slides, and we did this about a year ago. So even if you were here, you probably forgot it. Thanks, Myrnis. I'm going to show you Sally's. Is there a Sally in here? Sally? I'm going to show you Sally's stats. Hopefully I didn't pick a name. I used to use Carmen a lot, but there's a Carmen, so I'll try it. No Sally's, get it right. Here, Sally sends you her trading summary for the day. She sends it to you because you are the excellent trader that you are. And Sally wants to get some advice from you. Trade 1 made $200. That's dollars. It's not Bitcoin, not Bupka, that's dollars. $150 on the second trade. Third trade made $50. Fourth trade made $50. Fifth trade, I lost $500. Grand total, lost $50. I'm going to have a long sip of my afternoon beverage, and I'd like you guys to comment. If I'm Sally, give me some advice. What would you say to Sally here to help improve if she needs any advice at all? Maybe she doesn't. I don't know. What do you have to say to her? I'm going to wait until there's a dozen answers out there, and then I'll start commenting on them. I don't want to scare some of you off if you're thinking the same thing that somebody put out there. There's nothing to be scared of. I'm just asking a question. I'm not going to condemn anybody. Well, I guess I usually do, don't I? I'm just going to read the answers here for people who are listening on a recording. Don't overtrade. Lower the risk amount to $50. Need more info to give advice. Cut losers faster. Make more profitable trades, Sally. Cosmo, you never know what you're talking about. Have a max loss equal to or less than your maximum win. Okay. What's her risk amount first? You can't answer a question with a question. There's some rule about that somewhere. Al, tighten the stop or lower the size. Too large versus the gain she got. Determine risk reward per trade. Not enough info. Ask risk reward per trade. Rewrite your trading plan rules. Need for more information. How to feel about, boy, now you guys are typing. Stop typing so much, everybody. Need to real profit against adjusted. Okay, looks like she's taking full loss on her losers. Okay. Well, something we're all agreed on, at least something we're all agreed on, is that she needs some help, right? You've all agreed to that. Let's say she was trading $50 risk. Well, let's say we don't know what she was trading. Let me say this to get your attention. What if I told you she did the exact right thing? Is that even possible? Yeah, 80%. But what good is 80% batting average if your winner wipes out everything and then some? Is it possible that she did the exact correct thing? You guys all evaluated her, and every one of you had criticism for Sally. Is it possible that I could look deeper into Sally and say, you know what? Sally did the right thing. It didn't come out that good this particular day, but you know what? She did. How is it possible that that's the right thing to do? Well, Steve, the answer depends on your trading plan. I mean, yeah, that's always the first right answer. But now the question is, Steve, what should your trading plan say, right? You can't hide behind that veil. Hey, how you doing, Steve? I saw your email. How are you doing? And the answer is always depends on your trading plan, right? But the question everybody wants to know then is, okay, what should be in her trading plan, Steve? What does she need to put in there to fix it? Obviously, she has to follow it. What does she need to do? Well, here's what I mean, first of all, just so you understand. What if here, folks, let me ask you something. Oh, is this on the slide? What if, yeah, I didn't, in another presentation, I did this on a different slide. What if, as you looked over her records, what if, those of you that say she should raise her risk amount to $50 because she did 500, right? Those of you that say that. Let's say we raise it to 100. So I tell Sally the next day, Sally, your max loss can only be $100, right? That's what some of you wanted to do, correct? So that means trade number 5 now is reduced to $100, correct, everybody? Would you agree with that? That if we said, Sally, don't care, just automatic in the system rule, can't go over $100, right? And you guys are probably thinking that would increase her $400, now should be plus $350, right? Is that what you're thinking? But here's what happens. We go back and look and we find out that before she made $200, she was down $150. Before she made $150, she was down $200. Before she made $50, she was down $125. You see what I'm saying, everybody? Under your improved guidance, you, the super trader who is going to help Sally, she now comes back with $500 losses and she lost $500 instead of $50. Does everybody... Seriously, does everybody see that as a possible outcome from your help? Do you see the math in any way? Everyone? You all answered the question. Everybody agreed she needs some help. But the correct answer is we just simply don't know. We just simply don't know what the right answer is for her because we don't have enough information. You cannot look at a trading record and determine anything. You have to look at her charts and her trades, right? It's quite possible that just by giving her a tighter, that she needed that much room. The idea, folks, is to maximize your profitability based on how you're trading or to change your trading to make you the most profitable trader you can be, but not to follow archaic rules that somebody told you one time. right? Some of the most expensive rules for traders out there are, you know, use this much risk, and when you hit it, follow it to the penny, because you're all afraid. Oh my God, if I have $100 loss and I make it 110, I'm going to go to trader hell or something like that. There's a whole lot of other stuff out there to understand, and it's about maximizing your profitability, understanding your trading and your charts. And matter of fact, let me show you something. A question here was, well, did she blow her risk amount? Do we even know that? We don't know, because we don't know what her risk amount was supposed to be. Those of you that said that she exceeded her maximum risk, we don't know what it was. Matter of fact, here's a fun slide too that I like to say. When you're new at trading, you start off with a $50 risk, let's say, at some point in your newness, not day one. And you have a great trade, you make 200 bucks. You have another great trade, you make 150. You have an okay trade, you make 50. Okay trade, you make 50. And then the wheels come off, and you get all upset, you get excited, you lose 500, right? That's because you didn't follow your stop and you blew it, right? You blew your trading plan. Has everybody been there before? Everybody been there? Yes? If you don't say yes, then you're a liar. You should just leave the room. Everybody's been there, at least one trade in their life, right? But let me show you what happens when you become a professional trader. I'm putting professional in quotes, right? When you get better, now we're risking $500. We're near professional now, right? So my first trade was, well, it wasn't great, but hey, it's green, right? Can't go broke taking a profit. My second trade was, well, okay. My third and fourth ones, I scalped out, so that I wouldn't be a loser on those either, and they were okay. And my fourth trade, can you yell at me about my fifth trade, anybody? Can you yell at me for that fifth trade? I followed my max loss. I cut that trade off the second it hit 500. And yeah, it's hysterical. And give me a 1 on the screen. Give me a 1 if any of you I just hit a light bulb moment with you, or you've realized this, that if you look at the left and the right, there's no difference. The numbers are actually exactly the same. You've been there? Anybody? And all you've done is you've taken a small loss amount with a huge loss, and you substituted it for tiny gains with a normal loss. It's just perspective. It's just what you call it. It's the same thing, though, right? Matter of fact, the saying is this. Wrong-headed saying is you can't go broke taking a profit. That's precisely how many traders do go broke. Amateurs go broke by taking large losses. Professionals go broke by taking small profits. It is not an answer. Some of these questions, some of these things people say are not answers. Tighter stops is not an answer. It's the problem. When you say tighten your stop, do you realize that you're increasing every problem you have out there? Do you realize that? Do you know how many people say to me that that's an answer for them or for somebody else, that they should tighten their stops? How does that even make sense on planet Earth? Tightening your stops creates more losses on traders who already are chart challenged enough to find the proper stop, right? Right, George, that's really, thank you, because it is a great comment to put out there for everybody, because that is a good way of phrasing what I agree part of the issue is that people, they don't have a concept of what they're doing, right? They're just out there flapping in the breeze, so to speak, right? Well, George, just to make my point though, what if you risk 500 bucks to make 250 and you got 80% of your trades right? Now, I'm not saying that that's the style you should have. I'm just saying that if somebody did that for the last year, I'd compliment them like there's no end. There is no magic number, is my point really. And this may, this is just words on the screen, but you know what I find for a lot of people, these are words that may ring a bell. Sound like anybody you know. Traders taking some education, traders some technical adeptness, trader has more winners than losers, traders able to consistently find plays that have decent moves, trader feels good about trading and considers themselves a success, but the traders break even at the end of the month, but the trader is always confident that next month we'll fix all that up and things will be great again. So these are, this section is on stats for your day trading, and it's really putting the stats to use. It's saying, what are you doing with these? What do most people do for stats? They close out the trading day. They, you used to say go to the bar. Now I guess you go to your kitchen and have a drink or two, go to sleep, get up the next day and do the same thing all over again. There is such extremely valuable information in your trades, even if you're completely new, even if you don't really know technical analysis. Do you know how much you can still learn from your charts? even if you don't know technical analysis, right? Just the simple human concept of not doing the same thing wrong day after day after day after day, right? Even without knowing what you're doing. I mean, you can self-train yourself. Matter of fact, that's why I told you I have all this free stuff. Some people want to do it. I tried to do it. I don't, I've learned not to tell people that's not a smart thing to do. You got to experience for yourself. People are different. I've told you, I've had people that, they're around for 2.5 years trying to learn. All of a sudden, one day they sign up for stuff, just out of nowhere. And then I've had people that haven't known me for 2 weeks, and they go, "You're the guy I want you to teach me." And I'm like, "Who are you?" So I listen to your YouTube videos, and you're the only person that makes sense of it. So it just depends. And if you can, I think you can self-teach yourself, but it's something that could take a long time and cost a lot of money is the issue. But you need to try it, I think. You need to try it because you have to, if you're listening to me, I guarantee you are an above average smart person, probably above average income, above average everything. But it doesn't mean it's easy to learn trading because it's different. Styles and management, next section. Question, I've been struggling. Do you have any advice? I don't mean in training. I mean, do you see what I'm doing wrong? This is like a comment I had after last week, and just a couple of quick blurbs about how they're doing. How can you answer that question, folks? I told you, even with all the information I gave in the last slide, we couldn't help Sally, right? I need a lot more than that. My answer is don't struggle. Instead of struggling, however you do it, why don't you learn what you're doing? Why don't you step back? Why don't you learn what you're doing and try it on paper first and earn the right to move up to the level of trading small risks. This is what everybody is told to, and I try to force to do that takes stuff with me, is so that you never ever have a bad experience. Nobody should ever walk away. If you fail at trading, you should never walk away having lost any significant amount of money. So learn what you're doing, however you want to learn it. Learn it. For some, if you just keep losing and you keep doing it, I mean, something's got to give. So there is no answer for anybody that asks me that question. What do you expect me to say to them? What could I say to somebody? I mean, I don't even know what they're doing, right? Here are some things though that. What section are we in? Style and management. So let me give you a couple of quick things, though, that I think are common issues with people. And again, this is not like trying to run through a whole gambit of stuff. These are a couple of top things that I think are big topics for people. Tight stops. Tight stops are the secret to making the most profit. Is that true or false? I'll give you this one because I already answered it. That's false. Tight stops mean you can lose less per trade, helping to minimize losses. Well, again, in the world, according to me, no. I mean, obviously, you could come from the school that says, well, you just take 1,000 shares of anything you do, and therefore a 10-cent stop is a smaller loss than a 50-cent stop. But why one trade is worth 5 times the other trade, I have no clue why. So I don't understand that at all. So to me, the only sensible way to trade means that you have all equalized losses by adjusting your share size. So tight stops means more stops and more times you lose your $500 or whatever it is. That's all there is to it. If you want to improve your consistency, start by taking some trades that you can actually stay with. I mean, number one would be know how to identify a trade you can stay with. But if you do, take a look and see if some of the trades you're doing work, but you're not in them because some reason, somehow, some crazy reason think that tight stops are the way to do it, right? For the average person, I always hear this thing, I've been taught if you're a good trader, good traders look for a 3-to-1 Sharpe ratio. Is that a good adage to say? Is that a good bench line? Is that a good general rule? If you're a good trader, you don't take a trade unless there's a 3-to-1 risk to reward in front of you. Is that a good rule? Let's not take any trade unless there's a 3-to-1 reward to risk in front of you. Well, I'm not going to say it's a bad rule. Nobody more than I likes to have a trade that has this kind of a snug little, I call it a cute entry, and has unlimited potential. As a matter of fact, anything that I take as a day trader has a target off the hourly or daily chart generally. Right, Meredith? So I love the potential for a big reward to risk, but to simply say 3-to-1 has some real flaws to it, right? Number one, flaw to that is, what if I told you, here's a one-to-one trade, and I guarantee you there's an 80% chance you'll get there every time you take this trade? Would you take a trade? Would you take one-to-one at 80%? Hey, thanks, Fire Tower. I'm sending the box of wine later this evening per our deal. You're good. What was the question? Where were we? Totally lost. Well, the answer is, of course, you would take an 80% winning ratio on a one-to-one trade. It's not even worth discussing, right? So how can you make the blind statement that I wouldn't even take something unless it had this potential ratio when you're, because just from common sense, no matter where your knowledge level is, don't you think it's true that different setups have a different rate of success? It doesn't mean they all go infinitively off the chart, right? So that's something we have to consider. You know, something else that's hysterical to me too is that the average person that says you need a 3-to-1, you know what their Sharpe ratio ends up being? It ends up being less than 1-to-1, right? So if you're shooting for 3 and you're only getting 1, but yet now you have the batting average suffering because you're going for 3, how is that good trading, right? But Kurt, what I just said though is the other side of that. That's assuming you actually get the 3-to-1, Kurt, right? And by the way, I am all for a high Sharpe ratio. Please don't get me wrong. My thing is that so many people use it as a fictitious thing, kind of like what you're saying. They're saying, well, if I get a 3-to-1, I only have to do this. But then you look at their records, they never get 3-to-1. They're taking 1-to-1. So they have the disadvantage, right, Kurt, of the tougher batting average, because if you're going for the bigger Sharpe, you're doing something that makes it riskier, right? So the batting average is that of a 3-to-1 trader, but then we're not getting 3-to-1. So the point is, you got to get the 3-to-1 if you're going for it, right? Oh, thanks, Walter. I don't think I've seen Walter here before, but welcome. All right, let's go on. I think this is a simple slide here. What's this slide about? Yeah, I'm going to fly through this here. Yeah, okay, this is simple. This is just saying, you know, you have a snug stop, you still lose the full amount of money. It's not that simple to just say you have tight stops. It's a secret to trading. It's actually, for the most people I help, just, telling you straightforward, because you're not going to get probably a better synthesis of reviewing traders than for me. This is one of the biggest problems, is people just thinking for some reason they have to have these really tight stops. And it defies common sense to me. That's why I don't get it. I get some of the stuff is a lot of trading is counterintuitive. Would everybody admit that? Whether you're on the losing side of the trade so far, or whether you've come across you're on the winning side, wouldn't you agree that good trading is actually counterintuitive? It really is to some extent. It is counterintuitive to a large extent. It's not what it is. As a matter of fact, I almost wanted to pull up, if I have time. I'm gonna go on tonight. This is gonna be I'm gonna be another overboard here, but I don't like to do that. But I'm not gonna do a part 3. One of my students sent me a chart, and he might even be here. No, he's not. He'll probably listen in. I'm gonna pull up the chart in a minute, and we're gonna go over it, because it struck me when I was replying to him that, you know what, this is kind of the issue with kind of good traders, where they're kind of there, but they're just not making money, and here's why. So I'll pull that up in just a second. Let me go to the next part of this, though, where I just did this verbally, so blah, 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 blah. Okay, this is all the stuff I just said. Here it is on the slides. I didn't advance the slides, sorry. The way you improve your Sharpe ratio / batting, or in other words, the way you get more winners keeping the same average winner, or the way you get bigger winners keeping the same batting average, is to get those great critical setups from the chart. It's finding those precise, I call them moments in time, where you're coming down and you're finding the beginning of a fair-sized move in its infancy. Not after the whole world has jumped in, not after 99% of the traders already recognize the move and now you're getting in at the end. I'm talking about being the second smartest person on the planet. I don't want to be the first one through the door. I always say I want to be the second one through the door, because the first one through the door, what happens? What happens to the lead scout in the war, in a battle? What happens to the lead scout? What happens to the #1 scout, the guy in the front of the line? Yeah, if somebody gets shot, it's the first guy. Yeah, so I want to be the second guy. In other words, if a trade's developing, I don't want to necessarily be the first guy out there, because if it ends up stopping, I don't necessarily have to be in it. I can wait and see, how it goes a little bit. So that's the expression I like a lot. Great step is critical, but it's also then what you do with it. I see so many people that find good charts and then they don't make money from them. So one of the issues to me is what I call precision. As a matter of fact, the entry word for tonight was precise. I like precision. People are drawn to, and again, I'm the first one to say there's a lot of different ways to make money. So I'm not critical of anybody that's doing well. But traders are drawn to these crazy, wild moving stocks, right? See it all the time. Whether it was the biotechs from recently, or whether you think the airlines are a buy today, or whatever it is. Because why are people drawn to these real volatile stocks? Why are people drawn to a $6 stock that can move $2 in one day? Why are they drawn to that? They're drawn to it because, well, they're looking for a home run. They're looking for a big move, right? But you know what comes with big moves? You know what comes with big moves, everybody? Is a bigger stop, right? Does it really matter if you move 60 cents with a 20-cent stop or $6 with a $2 stop? It's all proportional, right? You can't tell me the stock is crazy wild out of control. And I know there's areas, that's what we do, is we look for these little low volatility areas to enter. And that's exactly what I try and do. But I'm just saying, you can't, I don't like that. I like precision. I mean, if you want to make 3 times your money, taking the average stock that moves 60 cents any day of the week and finding a 20-cent entry, that's the way to do it to me, right? Because there's a second problem with that, is that the sloppiness is what I call it. It's the opposite of precision. Is that they move, they get slapped back really hard because there's this indecision, they stop you out. And most people, the way they trade, they're getting in late on strength, and then they're stopping out the second it doesn't go against them, and it's exactly backwards. If you've ever gotten in at the high, then stopped out at the low, and then it goes back up again, you get in at the high again, you get out at the low, you feel like a bumbling idiot if you've ever done that. And on the other side of that trade was a market maker who's selling you up high and buying it back from you down low, and you feel really stupid. So I don't like sloppiness. I like precision. That's what I teach everybody to do, is precision. I've not traded a biotech stock the last 2 months, a couple of exceptions, only because they didn't look like biotech stocks, right? I don't ever go after those things. And it's simple for people to show me a chart and say, oh, Paul, look at the money you missed. Look at this move it had this day. Okay, but you know what? The average person, if you did get that move, you took 37 attempts to get that move, and they all lost first. I'm not interested in that. You can be. I'm not saying it's against the law. It's not against the rules. But I really encourage people to just find boring precision. Wait for something to happen and do it over and over again. Exactly, Carmen. Exactly. Yes. Not knowing, so sloppiness, not understanding how far right it's just going to run, not knowing exactly where to enter, not knowing where the market is likely to bounce or stall, not knowing the types of entries, just not being a good chart reader means you lose something. And you don't have the odds in trading to lose anything. In other words, at the best, folks, the odds in trading are just enough to make money, just enough to make nice money. But you start peeling away any of those odds, and you're just down to nothing. You can't just be sloppy with stuff. You can't just, it's not so easy that you can just come in there and just take any entry. It's not that way. You have to do everything perfect all the time, then you'll be really good. You can goof up once in a while, but you can't just every day be sloppy about things, okay? And one of the ones I recommend you watch that kind of follows up on this conversation, because where it goes from here is one called From Chart Reader to Trader Investor. And again, that's on that free stuff page. And the free stuff page is nothing except a good spot for you to be. Somebody asked me once why I send people there all the time. I'm like, it's my site. It doesn't matter if you go there or not. It doesn't mean anything to me. I don't get anything from you going there. It's just a good spot to get some good information. And actually, I think this video, folks, notice when you're there, there's an archive page, and there's an archive page of the archive page. This is on one of the archive pages because it's older, but it's one of the beauties to me, one of the gems. Okay. Evaluating trades. This is the last section, and this to me is just something I want to review with you. And it's kind of, this is not going to be about evaluating trades in total. It's just an example of what you can see and what you can uncover. And I want to show you an example of why, to me, the entry is everything. I say the entry is everything, and that's one of my sayings. And people, it's a theoretical argument where people say, no, that's not true. It's this, it's that. And you know what? I end up coming back after listening to them. No, you're wrong. The entry is everything. Let me show you why. What is the entry important for? What's the job of an entry? What's the job of a great entry? There's going to be a three-part answer to this. There's level A of understanding, there's level B of understanding, and there's level C of understanding, right? Mirnas has gave me the level B answer because he's an experienced student with me. But the first answer is, what's the great thing about an entry? What are the blanks? It sets what for the play. Right, it determines your whole risk-reward situation, like we talked about earlier, right? Your entry, where you're getting in and where you're putting your stop because of your entry, sets up the parameters for how many shares you get, what your risk is going to be, and naturally your target doesn't really change. So if your target is constant, the more you increase your stop, the more you're decreasing profit, et cetera, et cetera. So it sets the risk and reward, or your entry and the exit, right? All the right answers. But it's way more than that. The other thing that it is what Mirnas has said, is that really the number one job of a great entry is to keep you out of a trade, right? How does it do that? Well, it sets the threshold for entry. It's not to say, well, it looks like we're moving up, I'll just get in here, and then you get in like that first scout in line and get shot. We don't want you the one testing the waters, right? So we want our entry to be able to do something where we have some security. It's really going in the way that we think we're going. You have this. I said this a couple sessions ago or somewhere, and I got a couple of people just love the saying that I did because some of you are scientific, I guess. But you can look at trading like an experiment where you have an hypothesis. You have a theory that's formed. You have this chart, and it met the conditions in your mind about what a chart's supposed to look like, and you have this theory. And then you test the theory by saying, well, now we have to see if we have, and I don't know how well this lines up, but we now have to test the theory by seeing if we come over this level, what's going to happen. It just, it's kind of that's why you have to look at things. It's never an absolute. It's always kind of, here is the setup, the hypothesis, and here's going to be our entry. Here's our trigger point. Here's what makes us, conduct the experiment, whatever it is. But most of you probably learn entries that come with strategies. And to me, something that I do that is very different, as far as I know, from most traders, is I separate entries from strategies. To me, they're two totally different universes. You can have any strategy you want, and then there's entry concepts. We all know what the strategy is supposed to have for an entry, right? It's over a bar, over a base, whatever it is. But beyond that, you need entry concepts that really help maximize both your probability of success as well as your overall reward to risk. To me, the entry is everything. But you know what? There's a third thing about an entry. And it's so soft and so subtle that many people don't even realize it. I'm going to go through this chart, and this is actually a trade that I did that I screwed up. And I want you all, because we're going to be done after this pretty much. Well, we're going to have like 5 minutes. I want you to type a 1 on the screen at whatever point you totally get what I'm doing and why it's a bad thing, and probably because you've done it yourself. So here we go. Assume you love this setup. It doesn't matter. I'm not here to discuss the setup, whether it's good or bad, or you like it or you love it. Assume you like this setup, right? So I take the entry up there, right? Now, this to me, and when I did this trade, this was not my entry. This was a terrible entry. George, I don't want to discuss at all whether or not this is a good setup. That's not the point of it. We're all going to agree this is a great setup. I did it, and it was a great setup. The issue is, I meant to get in here somewhere. I actually meant to get in below that red bar. That's where I meant to get in. I was watching it for that. This thing just shot up like a banshee really, really quick, and I missed it. But here is my thought process, George. I'm thinking, you know what? This thing's going up to 98 bucks, right? And I'm thinking, you know what? That's still a heck of a lot of profit. So why not get in, right? If you like the 3-to-1, I'm going to make more than 3-to-1 on this, at least with part of my trade. I don't usually take the whole thing unless it's my last trade. It's a walkaway. But does everybody? Well, I'm saying it's late for my entry. But do you understand what I'm saying? When this happened, I said, you know what? I'm gonna get in anyhow. Okay. And that's what I want to talk about, is the fact that, well, on one hand, does everybody kind of agree, at least to humor me, that, well, if you are going to get to 97 or whatever, who cares, right? As a matter of fact, let me ask that. If I tell you this chart's going to go to 97, who cares, right? It wasn't as good as you could have done, but you already blew that. Let's get some money anyhow, right? That's the thinking, right? Well, what happens is, because I'm in way up here, right? It starts to move in my direction. I say, great. And you know what I did? It's kind of hard to see it on here. Does it show it very well? It started to bounce a little bit, and I was already at like a half loss, right? Because, from wherever it was, because it came against me, because the entries up here is at a third loss. It was about a third loss, I think, if I remember right? So it made a little bounce, and I brought the stop up, right? Brought the stop up. Why? Well, because I was down a third of a risk unit already, and blah 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 blah. And guess what happened? The thing stopped me out. So okay, small loss, no biggie. And my point of this whole thing is, at the end of the day, the average trader is going to look back and say, well, you know what? I minimized my loss. That's a good job. And my answer to you is, you're an idiot. Go back and look at the chart. It made it. It ended up being a great trade. I forgot how these slides go, sorry. Not only turned out to be okay, but look what it did. Went to my target of 98. Oh my, right? Now let me ask you something. Is missed money better than lost money? Let's take a vote on that. Is missed money better than lost money? Very common adage out there. It's in some famous trading books and said by a lot of good traders. Is missed money better than lost money? I don't think so. I know it's a missed opportunity and it's not coming out of your account, but when you're a professional trader and you find your thing, see, I don't look for 97 trades a day. I'm trying to do 3 trades a day, and on a tougher day where I have to take a second swing, or on a good day where I want to add some profit, I may go to 4 or 5. So when you find the trade of the week and you pass it, that's not okay to me. That's not okay. If you take it and you lose 1 risk unit. If you pass a 3R trade, you lost 3 risk units. And it's not like it's replaceable. It's not like you go to the store and buy another great trade. You got to go find one, and that might be it for the day. You may be done. I missed it. Okay, whoops. It's not okay. But that's still not the point of all this. If you can hang in there, don't go anywhere. Let's replay this. Same chart, same thing. And let's pretend I wasn't getting a cup of coffee when I should have been staring at the screen, and I got in right when I wanted to get in. Now, some of you are going to say, Paul, well, you would never get in there. Anybody from the trading room? Would I get in here sometimes? Yeah. Yes, I would. The whole trading room people will tell you, yeah, I do that sometimes. But I just want you to play through the difference. And here's where, when you start realizing this, I want you to tell me if you really get what I'm doing here. Whoops, what happened? Oh, no. Oh, no, that's right. No, I have some slides here. I'm sorry. I paste these from another presentation. I don't know what they say. There are lots of things happening people learn about getting good at anything. Trading, investing, no different. I wanted to say this comment at the end. Okay, words, blah, 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 blah. So sure, the end can do a lot of things, risk, reward, blah, blah, blah. The most important thing is overlooked because it doesn't show up in your results, but it's hidden. That's what I want to say. It's hidden. Here's what's hidden. Guess what happens? If I'm in here and this move, which was my prior entry, is like a 2R move, guess what? Guess what I'm doing? I call this free money. What am I doing when this is up 2 R's? Follow along with me. What am I doing? I'm taking a third. Taking a third. It's called free money. Even if it wasn't a target, Mirna's right. When you put in 1 bar that gets close to your target, I'm out of some of that. Why? Because I don't know it'll ever go back there again. And then a funny thing happens. What happens when you take a third off? See, I mean, I'm not less psychological than any of you. I have built tools around me to deal with my psychology. Does that make sense? Does that make sense, everybody? I'm not emotionless, even after all these years, but I've built tools around me because I'm experienced that work for me. So here's a tool for me. I dump a third, guess what, on this pullback? I could care less. I'm not even looking at the chart. Right, people in the room? True. I'm not even looking at this chart. You give me a third out the door. Plus, I had my stop down here somewhere. So that means even if I end up taking this out the low of the day, I'm probably break even on the trade. Now, it's not that there's an important distinction here. I really criticize people for managing to be break even, but there's a difference between managing to be break even and just happening to be break even so you can go on and take another trade. House is money, right? So guess what? On this pullback here, I'm not staring at it, trying to minimize my loss or whatever. I'm literally not even looking at it. So guess what happens? When I'm up here, see up here where the arrow is? Now I put my stop down to here. And then what do? Everybody in the trading room, what do I do now? Well, you can add, not add, that's not the point. Go ride a bike, go for a walk. See you guys later. It's called walk-away time. Yeah. What a difference. So instead of a 1/3 hour loss and being proud of the fact that you minimize the loss, how about really examining what you're doing and saying, wow, I made a 5-hour profit. That's what this was. Does that strike home with everybody? The third thing about a great entry, not the first two things, but the fact that a great entry makes management so much simpler and can get you to those bigger targets. Late entries stink. Now, the trick is that most people I know that do early entries, they just stop out a lot because they don't know what they're doing. So the trick with that is you really have to know your chart. Yeah, be careful though, George, because understand, this is not like, this is not my seminar program where you're supposed to go out and start trading. This is useful tools for you. For those of you that want to try to learn on your own, for those of you that want to take a seminar 6 months from now and you're building up some experience and stuff. But the average person, if you just go out and try and incorporate what I said, you're just going to stop out a lot because you have to know the chart. The secret to that great entry thing is that you have to know the chart so well that you can be the second one through the door out of 100,000 people and be right. And it doesn't happen all the time. But there's no relevance to half the bar, Steve. You can, but you know, what's going to happen is you'll give back a little bit more, a little bit less often, but it doesn't change the grand scheme of things. You know what I mean, Steve? It doesn't change the grand scheme of the mathematics. If you put your stop a little bit lower, you'll lose a little more money, a little less often, but at the end of the month, nothing changes. You need a whole different paradigm of the way to look at this, okay? It's not always fun having to give some profits back, but yeah, thanks, Marinus. And finally, this was in the last presentation, but I want to put it in here just because, again, I got so many compliments and so many people saying, hey, unbelievable, I didn't really realize this, and I just want to show you something. You start off paper trading. Prove to me you can make money on paper so nobody ever gets hurt, right? And then move up to $10 risk. Prove to me you can make money $10. And what I want to show you is that when you start getting up there a little bit, and by the way, this slide here, it's saying, let's say you're risking $200 now. Okay, so you're getting up there in the risk, but you're saying, you know, can I really make a living at this? Number of trades per month, if you did 5 a day, it'd be 200 trades a month. Winning trades, let's say you're batting 50%, that's it. Sharp ratio 1.5, very achievable, right? Profit from winning trades 15,000, losses from losing trades 10,000. And I put in here a huge number for commissions and profit, and I decided not to take it out. This trade, you know, the math on this slide was done a long time ago, where it's figuring in a $15 per trade commission. And I decided to leave it in because you know what? For the most part, that's a zero number now, right? I also put in here, besides commissions, I put in trading room fee, buy your lunch at Portillo's, whatever you want, right? So understand, most of this commission fee, depending on if you're going with zero commissions or minimal commissions right now, most of that's down to zero. So you have a lot more profit. You could be looking at $3,800 profit on $200 risk with these numbers, right? But then what the point of the slide is this: don't change anything. Don't change anything you do. Have the mental fortitude. Go up to $300. Now we're making 3 plus 3, $6,300 if you put the commissions back in there. Go up to 400. Now we're making 5 or almost 6, close to 9 if you put the commissions back in there. 5, blah, 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 blah. $500 risk, making 8 plus making $11,000 a month. The point is that you may be at decent numbers. And the point is, again, watch that video I told you about from chart reader to trader investor. But the point is that as you get good, You don't try and triple your trades to triple your profits. You triple your risk, not overnight, but over a period of time. And that's how it just adds up. So take a good look at the math. There's a lot of math in trading. Okay. I mentioned to you that for the trading profits that I showed you that you needed only, because it was exceptionally low, you needed $60,000 buying power. And I said that you could have a prop account with $6,000 that would give you 60,000. If you're interested in a prop account, you need to email me. I'll give you my email. And I have nothing to do with this place personally. It's not my company. I'm not a part of it. But it's a great place that I've been referring to for years. If you need the ability to day trade and you don't have the records of $25,000, this is no hoops, no tests, no levels. You can put $5,000 in, get $50,000 buying power, and if you want to, you can lose it all tomorrow. I mean, that would be your stupid thing to do, but there's nobody stopping you from doing that. Wes says I have to get better at letting winners run. Here's the question I have. Because that's a common thing, Wes, for people to say that. But the answer always back is, okay, true, but how? How are you going to do that? And I don't mean how on the chart. Usually you've got the chart. How are you going to do it mentally? Devise your things you need to be able to do that. And you only do that by constantly reviewing what you did yesterday, what you did the day before. If you, and lastly, if you email me about this, I'll put you in touch with the place. And also, if you want to, at the same time, take the seminar program in conjunction with this, there's a little deal set up. It's not a real big deal, to be honest with you, but it's something if you want to do that. And finally, the next seminar program is coming up on June 6th. We're in the middle of the current session. As always, if you have any questions, feel free to email me. You know my email. Well, I'm sorry, there's people chatting me here. Trading room open house. There's no trading room open house scheduled. I only do one a year. I may not even do one this year because actually we are kind of getting full. I don't mind it continuing to grow, but I've always said I want to monitor and we start getting over 50 people. So I'm not really interested in pushing it right now, so to speak. There's a little price increase to slow it up that's been on the website forever and we crossed that. So there's not going to be a open house anytime soon. You can always take a trial. You just go to the website to do that. It's probably better than an open house because you can be there all week if you want to. Okay. Thank you, Jerry. Oh yeah. Well, again, management style awareness is a lot, personalized. I mean, you have to have the tools. It's like I always talk about with tools. There's different tools for different jobs for different people, and you have to know the tools first of all. What management tools do you even have? Other than sit there with a mouse in your hand and and pray it goes higher, and then how do you use those tools in a way that you can actually follow them? You can actually follow a management plan. A lot of people set up plans and they don't even come close to following it. Just like a diet, right? A diet's no good if you can't follow it, right? A diet is worth zero if you can't follow it. And finally, this last slide here I want to leave with you. I want you guys to think about a little bit. Wow, you're all still here. Amazing. I talk about the three-legged stool in every little presentation. I throw this out there for you guys to think about. And I want you to think that the average person, how terribly short they come in learning how to make money. And what do I mean by that is, here's the three legs I talk about. Superior technical understanding, psychology and or experience, and then math and probabilities. You need to understand all three of these things. And the average person gets a poor technical understanding. Correct, everybody? This is just a warning to you. I in no way am encouraging you to sign up for anything, anywhere, anytime. I'm just saying for those of you out there trying to learn, those of you that learn at events and watching videos and reading books, the best you will ever do, I assure you, well, I mean, unless you self-teach yourself over years, the best you will ever do is learn enough chart knowledge to lose money pretty quickly. Most of you agree with that? Because most people have a poor opinion of technical analysis because they never learn it, and then they say it doesn't work. And of course, they can't be at fault. It's not their fault. It's just that obviously this chart stuff doesn't work. And really understanding a chart is so different than even what I hear quote unquote good traders discuss. It's just a whole different approach I have. It's a whole different paradigm. And it involves all three of these things. You have to know a chart better than you ever think you would, and that's not hard to learn. It is literally a fifth grade mentality, education, understanding that's needed to learn charts. There's nothing hard about it. And then you have to understand how psychology and or experience can come in to ruin things for you. And to me, math and probabilities is a big part of this. And I don't mean high level math. I mean almost common sense type stuff once you understand it. It's what I call the moment in time concept. And it kind of aligns with the saying that goes, I'd rather make money than be right. Or it's not about being right or wrong, it's about making money. Some people don't get that comment. If you don't get that comment, to me, you won't ever trade successfully. Well, Carmen, you know what? I can prove to you that trading is counterintuitive. How can I do that, everybody? How can I prove? You can probably do it too. Just think about it. How can you prove trading is counterintuitive? It's very simple. Matter of fact, if I was in court in 30 seconds, I could prove this, and the opposing counsel would have to say, I quit, he's right, I don't have an argument, nothing I can say. Why is it counterintuitive? It's simple. Anybody who comes to trading and investing, I would say by definition, is at least average or above average because they have money, right? The average person doesn't have any money, folks. They don't have any money. They can't invest. They can't trade, right? So the average person coming to trading is above average, right? But yet 90% of them lose. What did they use when they came to the market? They used their intuitiveness. They used their common sense. They used their God-given knowledge. And 90% of that lose. Does that make sense, everybody? It's just that simple. Everybody untrained coming in the market just loses. It's that simple. And I don't think they come in trying to do the opposite of what they wanted to do, except for George Costanza. He probably does it. But everyone else comes in giving it their best shot, and it's wrong all the time. Well, not all the time, 90% of the time. So ipso facto, thereby, it has to be the case that trading is counterintuitive. Thanks, folks. I'm done. We got to get back to 1 hour meetings. I don't want you here at 90 minutes. Apologies. I just threw this stuff together and just couldn't stop. So we'll get back to 1 hour things next time, right? All right, guys, got to go. See ya. Have a good night.